I'll pop in and start saying hello to the attendees. We are now live, so hello and welcome to those of you joining just a few minutes early. My name is Charlotte. I'll be your Money Show host for this session. I do have Randy here with me in the Zoom room, prepared to begin on time at 2:10 p.m. That is Eastern Time, coming up again in just a few short minutes. Thank you so much for your patience. I hope you're enjoying the show so far. Welcome into those just joining us. Thank you for tuning in today. This is your Money Show host speaking. I do have Randy here with me in the Zoom room, and we will begin the next session on time at 2:10 p.m. That's Eastern Time, coming up in just a couple of minutes now. Hello, everyone, and welcome to the session. It is my pleasure to introduce Randy Cohen. He's the co-founder and co-CEO of PEO Partners. It's a PE firm that aims to replicate private equity-like returns through public market investing. Now, Randy's main research interests, are the identification and selection of money managers who are most likely to outperform asset allocation, risk management, and anything else related to building great investment portfolios. Now, to our live viewers, if you have questions for Randy throughout the session today, please share them in the live chat box. It is located on the right-hand side next to your video player. And with that all said, Randy, I will hand the mic over to you. I'll be here if you need me, but the floor is all yours.
Thank you so much, and thanks to everybody for being here, and I look forward to your questions at the end. I'm sitting here in Morgan Hall on the Harvard Business School campus. I've been teaching here at Harvard Business School for 28 years, and of course, Morgan Hall is named for legendary financier and financial innovator, J.P. Morgan, and I was sitting just a few feet away from here in my office in Morgan when I had a brainstorm 26 years ago, and led to me giving a speech about the idea of liquid private equity that I'm going to talk about today. I ended up giving hundreds and hundreds of speeches on the subject over many years, and then launching a business around the idea. And I'm excited to be able to share the idea with you here today. The business we created is not a PE firm per se, but it's a liquid alternatives platform. And so in other words, the products we produce are fully liquid and available to generally anyone to invest in. And the idea is to capture the benefits that big, super wealthy individuals, families, and institutions capture from getting invested in private equity to try to make those accessible more broadly. And of course, it's crucial for that to be possible, not only that it be possible to invest without needing some $1 million minimum, but also that the securities be liquid. And that's why we call this liquid private equity. And people will sometimes say, well, I don't understand, if it's private equity, how can it be liquid? And my analogy is to Diet Coke, right? Diet Coke doesn't taste exactly the same as Coke, but is the closest you can come to the taste of Coca-Cola while being a diet drink. And so what I suggested 26 years ago to an audience of big investors was, it's possible to capture the vast majority of the edge that private equity brings to the table while remaining liquid and accessible. You can't quite do everything private equity does, but once you add up all the pros and cons, you can see that you get something that we think has a real chance to deliver average PE performance with average PE risk, and yet do it in a way that's liquid and accessible. And so that's why we think it's a really potentially very important innovation. And as people work hard to make private equity more widely available, it's still the case that it's super helpful to have something that's liquid that acts like private equity. Okay, so what is liquid private equity? The key is that anything that deserves to go by the name liquid private equity will be invested in liquid companies, okay, in publicly traded companies and other publicly traded securities, maybe derivatives to provide downside protection. And so the core strategy is in 3 steps, and those are buy what they buy, lever like they lever, protect the downside. So first of all, who's they? Well, for what I think of as liquid private equity, it's really liquid leveraged buyout. Obviously, there are other areas that sometimes fall under the broad categorization of private equity. Sometimes people will say, real estate PE or venture capital or growth equity might be forms of private equity, but the origin of private equity is in the leverage buyout world, and that is where we focus. And so everything I say today, even though there are exciting things to do in terms of liquid venture or what have you, everything I talk about from here on out will be about liquid leverage buyout, okay? So when you say there's 3 steps: buy what they buy, lever like they lever, protect the downside, okay? They is 1,000+ leverage buyout funds in the United States, and then many more around the world if one chooses to pursue global versions of this. And those funds hold over 10,000 companies in them, right? And so think 10,000+ private companies make up the leverage buyout universe. Liquid PE is not going to buy any of those companies, because then it wouldn't be liquid. Then it would be holding a bunch of illiquid private companies. So instead, liquid PE says, we're going to buy what they buy in the sense of find the most similar portfolio of public companies possible to that portfolio of 10,000 private companies. And so maybe you'd have 200 or so public companies that create a portfolio that is maximally similar to 10,000+ private companies. That's buy what they buy. Then lever like they lever. Remember, we're talking about the LBO world. The L in LBO stands for leverage buyout. And so if you're going to match the risk and return profile of private equity, then you're going to need to use a little bit of leverage. The good news is not a lot of leverage, not a scary amount of leverage, typically about 0.3 turns of leverage. That is to say, in a typical private equity firm, they take in equity and then they borrow a whole bunch of money to buy the companies that they invest in. In liquid private equity, you don't need to borrow very much. For 100 million in invested asset, you buy perhaps 130 million worth of stocks. And so the risk is not overly high. It's just a modest amount of leverage, but it adds meaningfully to performance. And then finally, the third leg of the stool, protect the downside. Because obviously, sometimes the market crashes. Take the first quarter of 2020. COVID hit, market was down 20%. If you were levered 1.3 times, you might expect to be down something like 26%. Obviously, that's an enormous loss. Private equity takes pride in the fact that even in the COVID quarter, they were only down 10%, or at least they reported that they were only down 10%. And so if you're going to buy something called liquid private equity, you want to feel that if the market crashes like that, the losses are going to be moderated in the same way that private equity losses are moderated. Well, the problem is if you're buying stocks and the market's down, they're going to be down. And if you're levered, they're going to be down probably a little more than the market. So the only way to create a portfolio that doesn't go down too much in a crash is to hedge. And that means you're going to use derivatives such as put options, protective securities that pay off just like fire insurance. Fire insurance, building burns down, it's terrible, but the fire insurance pays off. A put option has a similar feature. It's insurance against a crash. And so you're going to need that crash insurance to get the private equity like payoff. So buy what they buy, lever like they lever, protect the downside. There's actually a step 0 that precedes steps 1, 2, and 3. Step 0 is get the data. You have to have the data on what private equity holds. You need to know what they hold now. Each quarter going into the future, you need to get updated data on what private equity is doing. How else can you buy what they buy if you don't know what they buy? And you also need backward-looking data going all the way back to the beginning of the century so that we can say, hey, how would this approach have worked historically? Okay, so that's the idea behind liquid private equity. Let's get a little into the details. And here's what I'm going to do. Because time is short, I'm going to do 2 things simultaneously. I'm going to explain how it works, and I'm going to make the case as to why you should expect it to perform approximately like private equity. Now, that's not proof, right? But it's an argument as to why you should expect it. If you think about investment strategies and you say, why would you expect an investment strategy to work? There's really 2 kinds of evidence you can have. One is logic. Logically, it makes sense that this ought to work. And the other is history. Historically, it would have worked. Okay, and so what I can tell you is I had this idea back in 2000 and I talked about it, and since then it has worked. If you'd followed the approach that I'm going to describe, you would have gotten private equity like performance historically. Okay, but that's not good enough because there's lots of things that would have worked historically. It doesn't mean they're going to work in the future. In order for you to have reason to think it's going to work in the future, it needs to make logical sense too. And so I'm going to describe what it is and why I think it makes logical sense, why I thought that in 2000 and why 26 years later, I still think that. Okay, so what is buy what they buy? Well, as I say, you get the data on what private equity holds. By the way, that's difficult data to get, right? You have to make a deal with one of a few firms in the world that really knows what's going on inside all 1,000 of those private equity funds. And they're going to drive a hard bargain because they don't normally want to share that data. But if you can show them that you have enough value to add through your analytics, you might be able to work that out. So say, fine. Now we know what private equity is holding. Well, one thing that means is we know what industries they're tilted towards. The interesting thing about private equity is what they hold in terms of the sectors of the economy is very different from the public markets. Just to give you an example, in the public markets, healthcare equipment and services is bigger than banking, but only by a modest amount. They're in the same order of magnitude. Okay, so they're similar in size. In private equity, there's 15 times as much healthcare as there is banking. Okay, so it just gives you a sense they don't feel any need in private equity to be beholden to what the public markets are doing. Okay, and so private equity has very different holdings, and they change all the time, right? Private equity, sometimes, they'll be super heavy in oil and gas. Other times they'll have almost nothing in oil and gas, depending on what's going on in the world. And if you think about it, it should be no surprise to learn that historically they've been very good at making these industry selections. Because if you think about being a giant private equity firm like Blackstone, you own oil companies, and you own software companies, and you own healthcare companies, and you own retail companies, and on and on. And when it comes time to put the next $100 million to work, you know who's succeeding and who's struggling because you own those companies. You're not believing some remote CEO or some economic report. You actually see what's going on inside the companies. And so it shouldn't surprise anybody that they're good at figuring out where things are heading, and as in the famous Wayne Gretzky phrase, skating where the puck is going. And I am not smart enough to know which industries to tilt towards, but I'm smart enough to copy off of the experts, which are these private equity firms. So if you have this data, you can match their industry tilts. So that's the first source of edge that private equity has that you can copy. And it's been argued by really thoughtful academics who studied this that it's the biggest source of edge for private equity. Now, another big source of edge for private equity is that they invest in the right kinds of companies, okay? And you can go into a lot of detail on this, but let's keep it at a very high level. If you're going to do a leveraged buyout deal, then what you're going to be doing is borrowing a whole bunch of money. Let's say if you're buying something for 150 million, you'll probably borrow 100 million of it and put up 50 million. And that means you're paying interest on that 100 million at a rate that might be, who knows, 10% or more a year. So you're paying out 10 million a year in cash. The only way you can do it is if the company you're investing in is highly profitable. So private equity has to buy highly profitable firms. But also, you can't pay too high of a multiple, because if you pay 40 times earnings for that company, then that means that $150 million company was only earning like less than $4 million a year. And how are you going to make $10 million worth of interest payments when there's only 4 million of profits? The numbers just don't add up. So everything private equity buys, with rare exceptions, of course, has to be high profit, low multiple. Well, talk to any quantitative analyst of the stock market, talk to any finance professor. They will tell you the best performing kinds of companies historically in the markets have been high profit, low multiple companies, what they sometimes call quality and value. Okay, so first you're in the right industries. Then within each industry, you're buying those high quality, high value companies that tend to be the highest performing kinds of companies. And again, any liquid private equity worth its salt is going to copy those two features, which are two of the most important features in private equity. Okay, great. So you bought what they bought. And by the way, there are other elements that you can copy from private equity and add even more edge. But again, our time is limited, so I'll be quick. Okay, what about lever like they lever? Well, as I mentioned, you don't have to lever too much. Why not? Right? I just told you that 2/3 of the money in a leveraged buyout deal is coming from debt. That sounds like a lot of leverage. Well, remember, a typical public company has about 30% in debt. Okay? But these aren't typical public companies. These are the ones with high profit and low multiple. They can borrow a little more than a typical company. They're probably 40 or 50% debt on average. Well, so then a little bit of leverage gets you to that 60 or 70% debt ratio. That is what's typical in private equity. So you only need to put a little bit of leverage on. It adds a couple hundred basis points on average to performance. So it's very meaningful, but it's not too risky. And that's especially true because you're going to do step 3, protect the downside. If the market crashes, you are going to lose a lot on the stocks, but you're going to get a bunch of it back by having in place insurance against a market crash. And there are lots of different ways to get that insurance. Usually they involve derivatives, or, which could be swaps or options or futures. There's a lot of different ways to play it. But the upshot is you buy something that amounts to insurance against a crash. Okay. So we've matched so much of what private equity does. We've matched the most important things they do in terms of picking out companies. We've matched the edge they get from leverage. We've matched the smoothness that private equity offers. By the way, private equity doesn't hedge. They don't use derivatives. The way private equity offers a smooth performance profile is through what they call mark-to-model accounting, as opposed to mark-to-market, which is what stocks do, mark-to-model. And what that means is COVID hits, market goes down 20%. Private equity said, you know what? We see that stocks are down, but we think the market panicked. We don't think that stocks should have gone down as much as they did. And so we're going to say that our portfolio is not down as much. Now, I will tell you, my friends who run mutual funds were enraged by this. They were like, hey, I also don't think my stock should be down that much, but I have to take the mark down anyway. But this is a privilege that people in private markets have, is this mark-to-model approach. So they say it's not down too much. Many people are skeptical and say it really is down a lot, but they tell you it's not. With hedging, you make sure, or at least you maximize the probability that you are not actually down too much. And that's what's so powerful about hedging. Okay, last piece, and then we'll go to questions. So we've named a bunch of things that we can match private equity on. Are there things we can't match? Well, it turns out there's a little bit that we can't match, right? And the most important thing that you can't match is operational improvements. So private equity, one of the things that makes private equity so great is that they can take over a company and make it better, right? And with liquid private equity, you're just going to be buying little slivers of 200 different companies. You're not going to be able to make those companies better. So that is the pride and joy of private equity, and you can't match it. So let's just think about whether it's a deal killer for liquid private equity. Well, I like to think of this as a miniature Harvard Business School case study. Let's imagine you have mom and pop, and they started a store in the Pacific Northwest in the 1990s. And it was a big hit. People loved it. And now they have 17 stores, and it's very successful, a nice, profitable company. Mom and pop are in their 60s, and private equity takes notice. They say, you know what? We could buy this chain of stores, and we could make it better. First of all, it's already profitable. Second of all, we could implement best practices. We could do sophisticated things with new technology like AI that mom and pop haven't cottoned on to yet. And we could roll up this company with some competitors and maybe reduce competition in the space. And we could take this regional company and take it national or maybe even global, because we've got the deep pockets of private equity. Let's go in and offer $300 million. So they offer $300 million to mom and pop. And mom and pop say, wow, this is great. We were thinking about retirement. Our children don't want to run the business. $300 million is a healthy offer. We're interested. But you know what? We have to make sure we get the best deal we can for our descendants. So we're going to call our banker. And since Randy's in Morgan Hall, we'll call our banker at JP Morgan. And the JP Morgan banker is going to find 6 bidders out there, 5 other private equity firms along with you guys. And we'll have an auction and we'll sell to the high bidder. And Bain & Company did a study of these deals and found that the typical control premium that you have to pay in order to take over a company in a PE deal is a little over 30%. So that $300 million company, they end up paying $400 million for it, okay? And the way that you should think of that is that 30% premium, the PE people are so good at improving companies, they're probably adding 40 or 50% to the value of the company. And only 30 of it goes back to mom and pop. So they're doing a great job for their investors. They are adding a lot of value for their investors, but their fees are very high, right? I've been teaching here 28 years. Every year, many of my very best students go off to work at these leveraged buyout firms. And that's because it's fascinating work and you make a ton of money. And where does that money come from? It comes from fees. A typical private equity fund, according to the study that they did at CalPERS, the giant pension fund in California, they pay, once you add up operator fees, monitoring fees, origination fees, management fees, and carried interest, they're paying 7% a year in fees. Whereas a liquid private equity fund is probably going to charge more like 1% a year in fees. And that gap of 6% means that even though private equity will do better than liquid private equity on a gross basis, before fees, on an after fee basis, it's very reasonable to expect that liquid private equity will do as well as average private equity. And there will always be superstar private equity firms that do better than either average private equity or liquid private equity. But you know, most of the slots in those superstar firms, first of all, not as easy as people think to figure out which ones those are going to be in the future. And second of all, even if you could figure it out, those slots may be reserved for the giant institutions and the guys with $100 billion. So for ordinary investors who would be very happy with average PE returns, because average PE returns are great. If you're 60-40 stocks and bonds, and you can go to 50-30-20, 50% stocks, 30% bonds, 20% in private equity, historically that's added about 100 basis points a year to performance, 1% a year. And remember this, and this is the lesson I always leave my students with at the end of my investments course here at HBS, 1% a year for life doubles your money, doubles your money. So if you can go from 60-40 to 50-30-20 with 20% in private equity or liquid private equity, you can potentially, if things go according to history, and we think they're going to, then you can end up at the end of a lifetime with twice the money. So it's hugely impactful to get this right. And that's why you know, I've worked hard to develop this idea and develop it both in academia, but also in the real world with people I work with at PEO Partners. And so thanks so much for listening. And if there's time for questions, I'd sure love to answer some.
Fantastic, Randy. Thank you so much. I'm just going to go ahead and pull up that info screen again with the contact information while we do the Q&A here, so that those of you watching live, you can now see. If you do want to reach out after the session, you can feel free. Now, Randy, you may have covered some of this stuff already, and I apologize if so, but just for anyone who might have come in late. So how does volatility compare to traditional private equity and public equity indexes?
Yeah, so I would say volatility, if liquid PE is done right, volatility would be substantially lower than traditional public equity than public equity indexes. The goal is to get it all the way down to private equity. By the way, just to give you an idea, public equity has been, you know, high teens volatility historically, 16-17%, probably depends, you know, what time period exactly you use. Private equity has typically reported more like 10% annual volatility. Now, the actual volatility of private equity, if you had to use mark-to-market accounting, would be a lot higher than that, probably just as high as public equity. But so what you try to do with liquid PE is get all the way down to around that 10% range. I'd say realistically, it'll probably be a little higher than that, but I think 12 to 13% volatility, so almost as low as what private equity reports, is very doable. And by the way, that private equity number is for the entire index. That's if you were invested in 1,000 private equity funds, but nobody can do that. So if you take a realistic private equity portfolio with, say, 10 or 15 or 20 private equity funds, then I think liquid private equity can very, very plausibly get down to the same volatility level that a PE portfolio would have.
Thank you, Randy. And I had a couple of questions just come in at the same time, and I would like to get to both of them, but I am going to start with this one from Mr. Castleman here. He said, sorry if I missed something. I'd like to know, is this liquid private equity fund something an individual creates for himself or buys into?
No, it's a fund one would invest in. So people can create these in ETFs, in UCITS outside the United States, which is similar to an ETF. In theory, one could have liquid PE mutual funds or what have you. So it's something that a person would invest into.
Thank you, Randy. And then the next question here is, if you had to compare, how is your fund better than private equity ETFs like XOVR?
So, private equity, like a lot of people will create things that they'll refer to as a private equity ETF. But what it'll typically do is hold the stock of firms that execute in private equity. And in other words, it'll hold stock in companies like Blackstone or Fortress. That doesn't really have the benefits of private equity because you get all the volatility of the stock market. There is some talk about allowing ETFs to hold more in the way of private assets, and that would be a bigger change. Then you would get to questions like, what we've typically seen is ETFs, and I don't know if anybody's doing this in the US but abroad, where they would invest in funds of things. Now you're paying an additional fee layer over and above all those fees I already talked about from private equity. So it really does depend. There's a lot of different ways to structure things. But what I'd say is that liquid private equity really is liquid, and it gives you the full, sort of liquidity and accessibility, as well as the sort of hedge component that comes from downside protection.
Thank you, Randy. And what should I be looking for? What should I evaluate when choosing a liquid private equity fund?
Well, I would say, there's not tons of choice out there at this time. It's a pretty new idea in the markets. But what I would look for is people who are thinking really clearly about what makes what private equity does that adds value and how they can copy that into the public markets. And there are always going to be certain things that private equity does that you can't quite get in the public market. So just to take an example, a private equity fund, before they buy a company, they're allowed to go inside the company and get all kinds of inside information. Even when they buy a public company, which is only a tiny fraction of PE deals, but sometimes they take a public company private, they're actually allowed to know the inside information secrets and then buy the company because they're not going out and making a public market purchase. And obviously in liquid private equity, no one's ever going to tell us the secrets of any public companies. And if they ever did, we of course wouldn't be allowed to trade that company. We'd have material non-public information. So the point is, there are a few things out there that you cannot actually copy into the public markets. But the notion is really work hard to get the best data and have the best analytical team to understand everything private equity is doing, and the 90% of it or the 75%, whatever it is that you can copy into public markets to get that exactly right, and then charge you a fair price for that.
Thank you, Randy. Now, just a couple more questions here. You mentioned that it's kind of slim pickings right now. Do you expect liquid private equity to become a more widely adopted asset class?
I do. It's going to be a big, big deal. And there's a lot of need for it. This isn't quite as relevant maybe to this audience, but the institutional investors need it too, because they have a challenge. No matter how big you're, $100 billion pension fund, you're supposed to have 20% PE, let's just say you decide. You want to have 20 billion in PE. Well, the problem is you're never going to have 20 billion in PE because every day prices move on everything. By the way, the value of your portfolio moves, so the exact amount you're supposed to have. So what they tend to do is have 17 to 19% PE and 1 to 3% in what they call the funding asset or the liquidity buffer, i.e. it's sort of sitting in cash because you could get a capital call anytime in private equity. You have no idea when that's going to come. You get 10 days to send the money in, so you better be ready. And so liquid private equity has a huge role to play for those institutions, for the new evergreen funds that we're seeing in private equity. It really plays a role across the board. So I think we're going to see lots and lots of people doing interesting things in liquid private equity over the next 10 years.
All right, last question I have for you here, and we do still have about 5 minutes left. Are there trade-offs between liquidity and return potential?
My view is on a pre-fee basis, yes. In other words, if the fund manager wasn't going to charge any fees, then the manager who can invest in illiquids will have certain sources of edge over the manager who only can invest in liquid stuff. Okay. Now, the standard claim that was one of the original things powering PE was they said, look, if you had two siblings who started identical companies and then they're equally valuable, and then one of them goes public, the other one stays private, the public one used to be worth about 25% more. And people said, well, there is a illiquidity premium by buying the cheap illiquid one and then maybe taking it public, you get that pump, right? And so that was a powerful argument for private equity. That is no longer really on the list of sources of edge for private equity. What's happened is that private equity has become such a big business that the illiquid one costs just as much as the liquid one. So the obvious reason why illiquids would have an advantage was true in the 90s, maybe in the early 2000s. I don't really think it's true anymore. But there are still subtle advantages of being able to invest in illiquid stuff. And if they charge the same fees, then it might be a real advantage. And then you'd say, well, I'll get higher performance in the illiquids, but I have less liquidity. And that would be the trade-off. My view now is, on average, there isn't even a performance advantage to being in the illiquids on an after fee basis, because the fees that people charge for doing the admittedly super hard work. I mean, I want to be clear, they're earning those fees. They get inside those companies and they tear them inside out. They do a ton of work. So that's why they get paid so much. But the effect of it is that on a net basis, you're not really winning with the illiquids. You're paying the penalty of being illiquid and less accessible, but I don't think you're getting a real performance premium.
Thank you, Randy. And I do actually have one more question that just came in for you. This says, more on the academic side. Some books, like The Humble Investor by Dan Rasmussen, claim that private equity is a bubble and should be avoided. This was back in 2025. Have you come across anything that contests this thesis?
Yes, so let's see. Remember this, there's always a difference between the value of the stuff that's currently in private equity funds and then new private equity funds, okay? And so Dan's argument, which I think has a lot of validity, is that when the market got smoked in 2022 and was down about 18%, private equity said they weren't down at all. That's that mark-to-model accounting, right? So they said, we're not down at all this year, okay? Now, let's be honest. Obviously, if stocks are down 18%, private company values are also down. And by the way, it's not like stocks went down 18% because of animal spirits. Stocks went down because interest rates went way up, which everybody knew. And we all know that the value of stream of future dividends is worth less if you're discounting it back at a higher interest rate. Okay, so private equity, in my humble opinion, should have taken some substantial markdowns in 2022, and they didn't. And so for the last few years, private equity has had this problem. They've had a hole to dig out of. In other words, they've been saying, they bought something for 100, they marked it up to 150, then the market got hit. They should have marked it back down to whatever, 115, and they left it at 150. I'm making up numbers here, of course, but just to give you a sense, right? Well, then what happens is if you have a good year, you kind of, you had it, you're saying it was worth 150, it's only worth 100. If it goes up to 125, well, you already had it marked at 150, you see? So it is true that existing private equity portfolios over the last few years have been marked at prices, in my opinion, higher than true value, right? And so I would not be excited to take over a position in an existing private equity fund at the full market value of it, because they're saying it's worth a value that in my opinion, is higher than what's real. Again, every fund is different, but on average across the industry. But that said, that does not mean that being in a new private equity fund with new deals is necessarily a bad idea. You see, because that's fresh cash going into a fresh deal at a fresh price, not an old stale price. So I want to be, and I think Dan, by the way, would probably agree with me about this. So, I'm not going to put words in his mouth, but I'm saying this is not necessarily an argument between him and me. This is, just a clarification of what I suspect he meant and would think that I show.
Well, Randy, thank you so much for joining us today. Thank you so much for answering those questions with the audience as well. I know they appreciated it.
Thanks so much, everyone.
And to those of you watching live, of course, thank you for joining us. And be sure to stay tuned as we have a lot more in store for you throughout this Money Show Virtual Expo. I hope everyone has a wonderful rest of your day. Take care.